Hi, folks. This is Peter Lemieux from the Insurance Exam Queen. Going to talk this afternoon. Let me see. How do I get this in the center? Oh, move my chair. A technological genius at work in front of your eyes. We'll wait till we get some people into class before I start yapping. Hello, hello. I'm Peter Lemieux. I'm going to talk today at this live class about property and casualty basics. Kind of fundamental language that we need to pass the test. Um, I'm working with people one-on-one, and some of the people who are scoring low, it really starts right here with this basic information. They're not clear on the concepts and on the words of insurance. Now, all the other stuff that comes after, like policies, provisions, perils covered, and things like that, are built on what we're going to talk about today, okay? Property and casualty basics. I'm looking to see how many people we have here, and I'm expecting a few more, so I'm going to just pause a little bit while the massive crowd, the Taylor Swift type of crowd pours in. They're a little late today because they're out at the booths buying t-shirts and posters and big pins about I love Peter. So that's kind of delayed the entrance to the class. Um, but welcome. And if you've ever been with me before, um, I don't know how to describe it. I try to keep things basic and simple. I do try to throw in self-deprecating humor, which means I make fun of myself. Um, And hopefully, with all of that, the amount of time we spend on topics will move quickly and in a way that you can understand. Let's tell the truth, my friends. Nobody wants to sit down and have an hour talk about insurance. Come on. There's other things in your life that are more important. You're here, and I understand this, because you're trying to pass a test. And I'm here to help you pass the test, okay? So I can't do anything to make insurance entertaining and exciting. It is what it is, but you need it to pass the test, okay? So we're going to get started now because it is time, and I don't want to waste your time today. I'm going to mention this at the beginning and at the end of class. The cost of studying at Insurance Exam Queen, there is a discounted way to study. If you go to YouTube, Insurance Exam Queen, and click on Join, you can get all of Melissa's P&C videos, not for 90 some odd dollars of the gold plan, but for only 30 some odd dollars. The difference is this is rented. It's good for 1 month. And if you plan on getting your studying done in that time, you might want to look there to save yourself a couple of dollars because you get the same videos. I'm a big believer in taking notes. Whether you're watching videos or joining us live, please take notes, okay? So let's get started on the topic. Policy, provision, and contract law, okay? General topics. These are things you've got to understand. There's 6 words on the board. If you know all of them, you're doing well. If you want to just be reminded, that's what I'm going to do. I'm not going to teach them deeply, but I want to remind you what they are. We're talking about insurable interest, underwriting, perils, loss, blanket insurance, and specific insurance, specifically addressing those people who look at these and say, I've heard of it, but I can't explain it. So let's see if we can help you out. Okay. Let's start with insurable interest. Melissa calls this BB dollars. BB dollars is insurable interest. What do we mean by that? Blood business, or money. You must have a relationship with the insured, be it a person or property, that is blood, business, or money. I cannot insure property that I have no interest in. Okay. I have to have some form of interest. And those are the three that keep us going: blood, business, and money. You must have an interest into the item or the person that you are insuring. For example, cars you own, house you own, etc. Okay? For a person, you need to be related or married to insure them. Also, friends are not someone you have an insurable interest in. What's not mentioned here, it's probably coming up, is business relationships are insurable. I can insure a business partner, a key employee. Um, Business also develops a relationships. You got blood, business, and dollars create an insurable interest. Back here. Okay, so now we're going to talk about word underwriting. I'm sighing because there's something very important about this risk selection that I hope you all get a handle on. One of the biggest challenges to an insurance company's survival, keeping them from going bankrupt and still paying their claims, is what we call adverse selection. You should be familiar with those two words. Adverse means against, selecting against the insurance company. Simply spoken, adverse selection is when too many bad risks join the insurance company with a policy, which down the road will, by law of large numbers, create larger claims than they are expecting. When an insurance company gets larger claims than they are expecting, they only have two choices. They either have to raise the rates to get more money in. What's the problem with that? If you raise the rates too high, people don't want to buy from you. Or just close their doors and just not accept any new business. And that's the beginning of the funeral for the insurance company. So, underwriting is that process to make sure we don't take on too much adverse selection. Insurance is the transfer of a risk. So, it's important to fully access how much risk a person has when they transfer it. This is a risk selection process. A person with multiple accidents is more likely to have more claims, so they are transferring more of a risk than a person with a clean driving record. I want to go back, okay? So basically, what we're talking about is a process where the insurance company is going to assess this application and see, can we take this at normal rates? Do we need to charge them more? Do we need to put in exclusions and tell them we won't cover certain things? Or do we need to go, we're not going to insure you at all? The underwriting process is important to the survival and profitability of an insurance company. As salespeople, we often hate underwriters because we want the policy approved so we can get paid, right? But underwriters really are protecting the future of the company and, in the end, our future. If you work for a company that's losing money, it's you're walking toward the cliff. Okay, so you want to make sure it's profitable. So we need the process of underwriting. It's very, very important. Risk selection. Now, you guys are all studying property and casualty. You understand how important the word peril is. Peril is that which causes the loss. So let me just refresh your memory. I know you guys are on top of this. When you study a very important chapter on dwelling policies, what's the difference between a DP1, a DP2, and a DP3? The difference is the perils that they cover. The more perils you cover, the better the policy and the more expensive it is. But perils dictate the quality of the policy you're buying, right? You want to buy the least expensive policy, you would gravitate toward a DP1. Why? It covers the least perils, which means you won't pay very much. It also means if you have a claim, there's a good chance it will be uncovered. Okay, it's really a simple process. So perils are the reason you file the claim. The cause of the loss, the reason you file the claim. Insurance does not cover all perils. And you know that when you study the DP1, 2, and 3, perils that are not covered on the DP1 can get picked up on the DP2 or the DP3. Okay. I tell this story. It's kind of like going out to get pizza. Okay. You can get the cheese pizza for a certain price. Most people don't settle for just the cheese pizza. The kid in Home Alone, he ordered cheese pizza. If you don't know what I'm talking about, you're too young. Okay. Cheese pizza, we get it. That's a basic. That what might be our DP1. But if you want to put stuff on top of the pizza because you enjoy it, gives a better flavor, right? Maybe you like sausage or pepperoni or whatever, jalapeno peppers. You can add things on top of the pizza. It will create, if you are have those tastes, a better tasting pizza and you'll pay more for it. So perils kind of work a little bit like that. No policy covers all peril. And um, this brings me to these words: the difference between a named peril and an open peril policy. A named peril policy will tell you these are the perils that are covered. And if you're familiar with what I'm talking about, you will know named peril policies, DP1, DP2, name the perils. However, when you graduate to the DP3, it becomes open peril on the dwelling, not on anything, but on the dwelling. What's the difference? On that DP3, it covers everything except exclusions, like burning down your own house and things like that. So if you want the pizza with everything on it, you would be getting an open peril policy, cover everything, okay? But if you want to limit it to just certain perils, you would get a named peril policy. What am I doing here? I'm trying to explain a language that's critical to you passing the test, okay? A policy that only covers perils that are named um, is a named peril policy. If the peril's not named, it is not covered, okay? Open peril will cover any perils except exclusion. So if you have an open peril policy, what you would do is you would turn to the back of the policy and see what's excluded. If it's not excluded, guess what? It's covered. Okay. So that's the difference. And it also points out the importance of the word peril. Loss should be somewhat obvious. Loss is what we put a claim in on. Okay. So you have a loss. Um, I got a person in here, Godspeed VR. I'm sorry, Godspeed, but I'm not familiar with that last name. Godspeed owns, let's say this, Godspeed owns a boat. He has a homeowner's policy. Now his boat is large enough that it's not covered on the homeowner's policy. If you remember, the homeowner policy only covers smaller boats. If the only policy Godspeed has is his homeowners and his boat gets wrecked, he will get zero. Why? It's not a named peril. Okay. Or if it's a DP, an open peril on the dwelling, that wouldn't count anyways. But you got to see, you only get paid if it's a covered peril. Now, let's talk about what the insurance companies call a loss. You're going to get questions on a direct loss and indirect loss. I spoke about this last week, and I'll be honest with you folks, when the class was over, I didn't think I did a thorough enough job. So, guess what? You're going to get the thorough explanation of these two words. A direct loss is a physical damage to property, which includes proximate cause of loss also. All right, Peter, I don't know what proximate cause of loss is. So we tell a quick story to help you out. Your house burns down. You go to look at it, and there is a ton of water damage. And you think to yourself, holy criminers, I know enough about this policy that not all water damage is covered. Will my policy pay me for my house? Why is there water damage? There's water damage because there was a fire and the fire trucks came and soaked your house. So the proximate cause is not the water, but the original cause, the fire. The water was used to control the fire. Fire is covered. So the proximate cause is where we would see if it's a covered peril. What's the real reason there's damage? And it's damage to property. Okay? Now, indirect losses as a consequence of the direct loss. So, for example, because my house burned down, I have to go and stay in a hotel. And I've got that in my policy under something called additional living expenses. Is the hotel bill a direct loss? No. The direct loss is the damage to the building. It's indirect because of there's damage to the building, I incur an additional loss. So you would have additional living expenses, also loss of rental income would also be indirect loss. Okay, it's because of the direct loss there are extra expenses. Okay, that is um, that's the purpose. Hopefully, that's going to be clear to you because I promise you, you're going to get a question on what's a direct loss and what's an indirect loss. So you got to be on top of this. It reinforces to me why you guys have to know your language, your insurance language, because if you don't, the questions make less sense and the answers make even less sense. You got to get the vocabulary down. Now we have a policy called a blanket policy. Very simple, very good use of the word blanket. Blanket covers the whole bed, right? It doesn't just cover one little item on the bed. So a blanket policy is a single policy that covers multiple classes. There's a lot covered in a blanket policy, as opposed to specific insurance that covers only one certain thing, its own amount of coverage. Okay. So blanket policies would be like homeowners policy because you got the dwelling, the shed outside, the contents. It covers a lot of things, right? A specific policy is I have a policy that only covers my wife's $50,000 necklace. That's all it covers. That's a specific policy. And if you folks think that my wife has a $50,000 necklace, I am doing a great job. Now, I want to talk about construction, basic types of construction and how they affect assessing the risk, right? Underwriting. Fire resist, that's not right word. Fire resistive. I think we're missing a couple letters. It's a house that's built with material that can resist burning down for up to 2 hours. Now, if you have a fire resistive building, that is going to be less expensive to insure than a building that's more flammable for understandable reasons. The opportunity to control this fire without a lot of damage exists in the basic construction of the building. Okay. It's a house, fire resistant. Oh, this is what Peter said in a more clumsy way. It's fire resistant, it's going to give you your best rating because it's less likely to have big damage, right? Now, a frame house is a building made out of wood. Of course, that's flammable. It's not resistive to fire. And the frame is made out of wood. A building that's made out of wood is flammable. Basic types of construction. This should not be a problem for you. The one that's less likely to burn will be one that is less expensive to insure. Now, as you're studying property casualty, this is one that's really critical to understanding the property is how does the insurance company value your property as they're insuring it? We call it loss valuation. Now, the first one we need to know is replacement cost. Replacement cost says whatever the loss is, we will replace with brand new material. I want you to just think about this for a second. This actually breaks the principle of indemnity. What are you talking about, Peter? Indemnity says we will restore you to where you were. Let's use the example of your auto. Most autos are insured with actual cash value, which means if you're driving a 2018 car and it gets totaled, we will give you enough money to go and buy a 2018 replacement, not a new car. We're not going to give you replacement value. We're going to give you actual cash value. But we have in some properties the ability to insure them for replacement costs, which says we will replace what's damaged with brand new material. Where we see it, just to tip our hands, I'm talking about coverage A, the dwelling itself. Coverage A exists in DP1, 2, and 3, homeowners 2, 3, and 5. Now, if I'm not making sense to you, just trust me. All these policies are going to cover the dwelling. The worst policy are DP1. Hey, great news, Cronus Gaming. Now you're going to go past California. I'll give you my email at the end, and you can send me an email, and I'll make personal recommendations. Okay, so I don't know if you guys are following me or not, but the only policy that covers the dwelling, the building for actual cash value is the DP1, our lowest level of policy. Every other policy, DP2, DP3, HO2, HO3, HO5, cover the dwelling at replacement cost. That's fantastic. And it really makes sense. Let me just tell it to you like this. If I have a roof on my house, wind damage wrecks the roof. So much so that we really need to put another roof on. But the roofing was 10 years old. Let's use simple math. $10,000. But because it was old, it probably was only worth $3,000 when it got wrecked. If I had actual cash value, the insurance company would give me $3,000 to re-roof my house. I can't find a roofer that'll put on used roofing material. So I'm not got very good coverage. I got to get a new roof. By having replacement cost, I can get the new roof. Okay. That's why replacement cost is the best form of coverage. It's not available on DP1. And also when you get into contents, I hope I'm not going too fast for you guys. Except for the HO5, all our contents are actual cash value. So replacement cost is not common, but it's the best cover. The brand new price to replace things at today's prices, the original price is not guaranteed at all. Replacement cost is exactly what it says. Now, actual cash value is, in terms of insurance, the more common coverage, except for the house itself, right? The actual cash value used to replace things is calculated like this. And Peter said this, but he didn't use the right words. Actual cash value equals the replacement cost minus wear and tear, minus depreciation. Your car, if you bought it brand new in 2020, is not worth what you paid for it in 2020 because of depreciation, wear and tear. So actual cash value takes the original cost, the brand new cost, depreciates it, and then you get the lower amount of actual cash value. I'm going to go back here because one of the things when I put my slide up without my picture on it is I don't get to read your questions or comments. Okay. Um, we are following. Wow. You guys are geniuses. That's great. Now, we understand, hopefully, what a replacement cost is. I mean, replacement coverage, actual cash value. Now we got another one. Okay. It's functional replacement. Functional placement basically says what'll work. You're going to put in modern, less expensive price to make repairs like using drywall instead of plaster. Okay. Great example. We're going to put in new stuff, but it's going to be whatever works. We're not going to replace it with exactly what you had. So if you had plaster and we can just put up drywall, it works. That's called functional replacement. Functional replacement is found out by what works. Now we've got another one, agreed loss valuation. Agreed loss valuation is a policy that sets replacement price of an item based on a fair valuation of that item used for an item that doesn't fluctuate much in value. In other words, this item doesn't depreciate. Here we would find stuff like jewelry and things like that. And the agreed price on those things would be you and the insurance company agree these items will be covered for X amount. They're not going to look at the replacement cost or the actual cash value or functional. They're going to look at what you agreed on. So what we've done here is we've looked at 4 different loss valuations, and now, just to mess with you, we're going to do a 5th one. Stated. Stated is a little different than agreed. Stated basically is the insurance, maybe this isn't correct exactly, but it's the way I feel about it. It's the insurance company drawing a line in the sand. We're not going to cover that for any more than this. Stated. It's the minimum limit the insurance company will pay if the item suffers a covered peril. So in other words, they say, I know you think it's worth this, but we're only going to cover it for this. My friends, 5 loss valuations you need to understand. If you want to take a picture of a slide, this might be a very good one for you to do that on. Now, I don't remember if I've got slides on this replacement, but there's something really important about replacement and co-insurance. I promise I'm going to teach it whether I have slides on it or not. Okay, are we okay? Anybody want to just say, Peter, slow down? Peter, go fast. I got a big lunch I want to eat. Something like that. Let's go on. Policy structures. Okay, I'm going to back up. I want to talk about replacement cost and the importance of co-insurance. Now, I've got a slide, so you guys got to write it down if you don't understand. If you understand it, just use this as reinforcement. If you have replacement coverage, like your dwelling and your homeowner's policy, it requires you to insure the building for at least 80% of the replacement cost. That's the requirement. So we use simple math. You have a structure that's worth 100,000. You don't want to pay for 100,000 of coverage because you say to yourself, it's never going to burn the whole thing to the ground. We're going to have a little claim here, a little claim there. So I don't want to buy 100,000. But because it's replacement cost, the insurance company says you must insure 80% of it, which is what? 80,000. So you go and you buy a policy for 80,000. If you have a claim, new roof for 10,000, because you did the co-insurance, the insurance company is going to pay the whole claim, all 10,000. Okay, because you did what they ask of them. Obviously, if the house burns to the ground, you only bought 80. Okay, but you met the co-insurance requirement. Here's the test question. They want to talk about people who don't meet the co-insurance requirement. So instead of insuring it for 80, because you're frugal, cheap, you only insure it for 40. You say, I'm not going to have any big claims. You were supposed to insure it for 80. So now you need a roof for 10,000. No problem, Peter. I got 40. Well, you really don't. Because you didn't meet the replacement cost, okay? The insurance company is going to pay the amount you covered over the amount you should have covered, meaning you bought 40 when you're supposed to buy 80. You bought half of what you were supposed to. So guess what? Because you didn't meet the 80%, the insurance company is only going to give you a check for 5,000 for the 10,000 roof. Half. You buy half, you only get paid half. So it's very important in replacement costs that we meet the 80% co-insurance to get the full coverage. And hopefully, let me just go back here where I can see um, the chat box. Are we okay? The importance of loss valuation and now co-insurance, is that okay? Are we making sense? A thumbs up is good. Have I confused you or have I helped? Hey, look, you can't hurt my feelings. I'm too old. Tell me how we're doing. Okay. Leave me hanging, right? Leave me guessing. All right. Be that way. All right. So we're going to just go ahead. Silence is approval. Silence could be you've left your computer on and you went to the kitchen to make a sandwich. I mean, I don't know what silence really means, but I will just go on doing my usual thing. We're going to talk about policy structures. In other words, how does a policy set up? And the test questions you get on policy structures are of this nature. Where in the policy do I find this? And you need to know about the policy structures. So here they are. Here's a good slide to take a picture of. There's declaration, definitions, insuring agreement clause, additional supplemental coverage, conditions, exclusions, endorsements, and certificate of insurance. So let's take a look at these one at a time. The declarations is the first page of the policy. It's a policy of summary of who and what is covered by what company and for what amount. It's the basic questions everybody wants to know without all the details. Who's covered? Who's the insurance company? What exactly kind of coverage is this? Is this an auto policy, a homeowner's policy, a boat policy? What is it? Okay. How much is covered and how much I pay for it? When people want to know about their policy, this is basically all they ever really want to know, unless they have a claim and they want to know if it's covered. If they just want to know what kind of policy they bought, you would look on the declarations portion of the policy, which is where? On the first page. Definitions is great because words come up in the policy, like in our class, and the insurer is not going to know what it means. They will find the meaning of the words where? In definitions. That should be very simple to remember. The insuring agreement, I don't know if you remember this, but under consideration, The insured pays the premium, fills out an application. The insurance company makes a promise to pay. The promise to pay is made in the insuring agreement clause. If a policy doesn't have an insurance agreement clause, which is impossible, but if it does, there's nothing covered. Okay. It's like buying a car with no engine. Here's what it discusses: what perils do we cover? We promise to pay. Who's covered? Who's the insureds? And when does this coverage go for? January 1st to December 31st, whatever it is. It'll all be in the 4 P's: perils, promise, parties, period. So, I mean, I don't think there's anything in here confusing, but what happens is people don't take the time to learn it. So let me go on my sales pitch here. Please make flashcards for yourselves. Once you make the flashcard, you write it yourself, okay? Question on the front, answer on the back. Then read it every single day. Furthermore, Uncle Peter tells you, read it out loud every day. You know what'll happen if you do that? It'll sink into the brain. That is how actors learn the lines when they have to perform live on stage. They got to know all their lines. They read them over and over again out loud. It's not hard. My friends, when I took this P&C test, I had a stack of flashcards, yay, about this thick. Okay, there. I read them out loud every day, and it didn't take me but about 6 minutes to read them. But I did them over and over and over again. What are 4 P's? I want to know them. Okay. So additional coverage, built-in coverage to all policies at no additional cost. So this is not like buying a pizza and adding pepperoni. It's additional coverage that just comes with the policy. In other words, it's not in the letters. It's not coverage A, B, C. You know what they are, right? Attached, unattached building, the contents. Okay. It's none of those, but you're still covered for it. Okay. You're covered for things like expenses you have to remove material for a certain number of days. That's not listed in A, B, or C, but it's in the policy. It doesn't cost you anything. Okay. It's like when you buy a car, the car comes with a spare tire. Do I have to pay extra for it? No, but it comes with it, right? Okay. That's what additional supplementary cost is. Now, conditions are kind of rules. It is not kind of. It says there: rules, duties, obligation, ways of behaving for the insurance company and the insured. So we look at these things often when there's claims. What obligations do I have? Protect the property from further damage. Okay. If there's a crime committed, call the police. What obligations does the insurance company have? Okay. What are the rules, the duties, the ways of behaving? Shouldn't be hard to remember that we find this behavior explained to us in conditions. Exclusions should be simple because exclusions is what we don't cover. Endorsements. This is changes made to amend the policy. If you add coverage, you add extra coverage to the policy, that would be an endorsement. You would pay for it. It's a change that you want done. That's the pepperoni. Okay. That is not an additional supplement, which actually comes with the policy like a spare tire. They're different. The endorsements, if you're adding coverage, will cost you more. Certificate of insurance is something that you can demonstrate that you're covered. Okay, perhaps a lender who you want to borrow money to buy a house or a car, you need to show them a certificate of insurance that says you're covered. So, my friends, those are all the declarations, definitions, insuring agreement, additional summary, certificate of insurance, conditions, exclusions, and endorsements are the structure of the policy. So, where's you going to see this on a test? They're going to say, you've had a claim. You want to know what your responsibilities are. Where do I find that? You're going to find that under conditions. Okay. I don't understand words of a policy. Where will I find that explained? Under definitions. You don't need to memorize these, what I got here, 8 parts of the policy, because they're never going to ask you to list the 8 parts. What they are going to do is they're going to give you a situation and you have to decide, where will I find that in the policy? If you understand these, then you're going to answer that question quite simply. Again, if you don't study this stuff and it's unclear to you, you haven't got a prayer of getting it right. So we go back to the same old story. Make your flashcards. This chapter does not explain anything about dwelling policies, homeowners, autos, commercial package property. So people tend to skip over this chapter to their loss. If you don't get this chapter down, none of the rest of it is going to work. All right. A few years ago, my wife and I built the house we're in. So we would drive out every weekend to see how it was coming. And for the longest time, there was no house. What they were doing is laying the foundation, putting the piping in for the gas, the water, and stuff like that. It's pretty unexciting. I wanted to see the house being built, the size of the rooms. But without this foundation, the house won't work. Okay? It has to be level. Okay? The water and the gas has to come into the house safely, efficiently. So while it may be boring, this chapter is critical to your getting ready to pass this test. Common policy provisions. To me, this is the simplest one. I hope it is for you. People are insured on the policy, but how do we know who's insured? Okay. Search insured. The insured is anyone covered in the policy. So we got this college kid, I hope. College kid on a homeowner policy living at home is covered. College kid's stuff in the dorm is covered. So who's actually covered on the policy? Okay. First named insured is about as easy a question as you can ever get. Okay. Your policy lists who's insured, but it doesn't list all the insureds. So maybe it'll list you and a spouse. Then one whose name is first is the first named insured. Hey, you don't need a high IQ to figure that one out. In a commercial policy, the first name insured is the designated person who manages the policy for the business. First named insured. There are other people not first named still covered. They would be named insureds because we would see their name in the policy. The named insured is the person who bought the policy. It's listed on the declaration page. Or let's say on my auto policy, I name myself and my spouse. I'm the first named insured because I listed it that way. But my wife is still a named insured because her name's on the policy. Pretty simple, right? Additional insureds are people whose name don't appear, but are covered because of the nature of the policy. Um, via an endorsement, or if you have a mortgage on your house, the lender to the house is going to be covered. They may be named or not, but they are insureds. Okay. So you have named insured, first named insured, Additional insureds, and the implication of additional insureds is they're not actually named, but they're covered. In a homeowner's policy, everybody lives in your house is covered. Okay. If you have a mother-in-law that lives with you, she's covered, but her name won't be on the policy. She would be an additional insured. Policy period, pretty simple. The policy will tell you how long you're covered for, from this date to this date. So what happens when the policy ends? Renewal. Okay. You can renew it or not, but the policy that you bought, you paid for a certain amount of time. And during that time, you are covered. Where are you covered? In our policies, you're covered in the United States, Canada, and the U.S. territories. Puerto Rico, Guam, Virgin Islands. I don't think I missed any, but those are territories of the United States. They are where you're covered. If you decide to go, we'll take a nearby neighbor not listed, is Mexico. You're not covered there because we cover Canada, but that's not a territory of the United States. United States, Canada, and territories. Now, policy limits are pretty simple. An insurance policy limits is the most amount of money the insured can collect under the policy. It's the amount of insurance you purchased. Okay? If I purchased $200,000 on my home and it burns down and I want 300,000, I'm sorry you didn't buy that amount. You only can get paid what you bought. Okay? That's not, you don't need to be a genius to see that one. There is a difference between a cancellation and a non-renewal. A cancellation is terminating a policy in the middle or during the policy period. What I mean by that is you're covered from January 1 to December 31st. But 1st of June, you don't want to keep the policy anymore. Could be for any number of reasons. Your brother went into the insurance business and he wants to change coverage over to him with a different company. The insured can cancel a policy anytime they want. Insurance companies, not quite. Okay. So you just cancel it. You tell the insurance company, I don't want you anymore. Cancel me. I'm not going to pay you. If it's done while you're covered, the policy will end on that date, but you're canceling it in midstream. That's a cancellation. Okay. Where a non-renewal, as we get to December 31st, it's time for the renewal. And you or the insurance company decide, we don't want to renew you anymore. We don't want to renew with this insurance company because they didn't answer their phones. I don't want to renew with this client because of things the client did during the year. They have to give you notice in advance, and you're just not renewing it. You're not canceling it. You're not renewing it. Of course, the end result is the same, right? You don't have the policy anymore. But you have to understand, and I don't think it's difficult, the difference between a cancellation and renewal. Anybody selling any kind of insurance, if you're going to sell insurance and you don't understand deductible, you're probably not ready to get a license anyway. Okay. I don't mean to put anybody down, but it's just the truth. A deductible is the amount of money the insured pays before the insurance company pays anything. We have deductibles in auto policies, homeowners policies, business coverage. We have deductibles in health insurance. We even have a deductible in umbrella policies, only we don't call them deductibles over there. We call them SIRs. Okay. But that's a topic for another day. Basically, if you say, I have a claim, but I have to satisfy my deductible first, that just means you pay the first dollars, and after that, the insurance company pays. On your auto, collision, okay, you have an accident, your fault, and you got to get your car fixed. The insurance company, if you bought collision, is going to fix your car after you pay your deductible. How much is the deductible? I don't know. What did you buy? Look on your policy. Okay. You pay that first, and the insurance company pays the rest. That's the way a deductible works. After the deductible, you may see coinsurance. However, in property and casualty, coinsurance is going to go along with what I told you before. Okay. You got to cover 80% of the replacement costs, or your claims will not be covered for the full amount. Other insurance. Other insurance is a provision in the policy that explains if you have more than one policy covering a loss, they need to pay their fair share of the loss to protect indemnity. Okay, let me say in English. You have two homeowners policies, okay? Now, just it shouldn't happen, but you have a $200,000 home, you bought a policy for 200 and then you bought another one for 100, okay? If that house burns to the ground, you will not collect $300,000. Why? It breaks the principle of indemnity. They will only cover what you lost. So who pays in that case? They say fair share. Company one at $200,000 has 2/3 of what you purchased. So they're going to pay 2/3 of the claim. Company number two at 100,000 has a third of the insurance. They'll pay a third of the claim. So however that math works out, that's what we call paying your fair share. You may see on the test the words pro rata. Pro rata means each company pays their fair share, so you get restored to what your house was worth, but you don't make a profit. We would at other insurance. We also got to remind you the difference between vacancy and unoccupied, okay? Vacancy means there's no people and no stuff in the house for at least 61 days. The house is empty. That's vacant, okay? Now, once your property becomes vacant, there's coverages that get dropped off, but that's for another class. But you got to know what vacancy is. Unoccupancy, the people are gone, but their stuff is still there. So maybe they went on a month-long vacation. That's not vacant because their stuff is still in the house. It's called unoccupancy. Okay. So you got to know the difference between vacancy, no people, no stuff, unoccupancy, no people. My friend, that completes my slides. Don't forget, if you go to YouTube, Insurance Exam Clean, click on join, you can get all of Melissa's P&C videos for like a little over 30 bucks. Okay. You only get them for a month, but I'm telling you, once you add the video, you can select which videos you need to study the most. You can pause them, you can back them up, and you can take all the notes you need. That's available to you. Now, I had a friend did ask me a question I want to respond to. Just a second. Our thank you for studying. I am going to list in the chat box my email address. If I can help you in any way, it's peter.lemieux@cox.net. Just drop me an email if it's just a single question or something you're confused about, and I can answer it in an email, I will. Okay. If it's you want to review the whole chapter on dwelling policies, I can't put that in an email. If you want to have a private session with me, I'm kind of like a counselor, only I'm going to teach you, not counsel you. You have to pay for that, and I'll share with you the cost if you feel you need that. Otherwise, if there's any questions that I can help you with, just whatever, give me a shot. I'll do my best for you. Final advice: study every day. Don't let this material go a day in the closet. Take it out and study something every day. Use flashcards. Flashcards should be read out loud every day. Do what Melissa suggests. If you buy one of her packages, which are the best deal in the industry, Melissa's packages for that cost is stealing. It's so inexpensive to get the best teacher available. So do what you can off of insuranceexamqueen.com. Let us help you pass. Okay? That's our goal. Now, finally, in closing, thanks a lot. Thanks for attending. Hopefully, you took some notes. Hopefully, I helped you. Look for live classes on the site. I do a few every week, and use the Insurance Exam Queen. Okay. Anybody got a question before you run off? Well, thanks for coming, everybody. Have a real good day. Stay healthy and study every single day. And hopefully, if I can help you in the future, you'll be back again. You're welcome. Thank you, folks.